Dear students, we have come to the point in our journey together where we will reflect and look back upon what we've learned. And we're going to go back to the very beginning of the semester when we described the eternal struggle of risk versus return, and how we can learn to eat reasonably well and sleep reasonably well. Yeah. With Chapter 11, Portfolio Diversification and Asset Allocation. Our portfolio is well diversified. It's 30% hopes, 30% wishes, and 40% prayers. Okay, it's not that funny, but and for some people, that's basically their allocation of their speculative investments. Diversification is spreading your investments across a number of asset classes to eliminate some, but not all, of the risks of investing. You've heard the old saying, don't put all your eggs in one basket, as opposed to the saying, put all your eggs in one basket and watch that basket. Now, it's attributed to Mark Twain, but it really came from Andrew Carnegie. Mark Twain made it popular. I don't know if I agree with that second thought. I don't want to watch my basket fall and all my eggs get destroyed. I like diversification. And so, of course, as we've said, everyone is different, and some people are going to be more risk tolerant and load up on just a few stocks, whereas the vast majority of us are going to want to play it safer and use diversification, at least 10 to 20 stocks and a few well-run mutual funds to give us broad diversification. Here is a graph, a table, from 1989 to 2013 showing the market leaders in blue, where we saw US large company stocks, global small company stocks, international foreign stocks, emerging markets, US bonds, international bonds, and cash, short-term instruments. And notice that in not one year, even 2008, did cash do better than anyone else. So really, I hope we've, this is a final nail in the coffin. We've convinced you that putting your money in the bank for the long term is really a losing proposition, folks. Yeah, sure, you're not going to lose any money, but you're certainly going to lose a whole lot of opportunity costs, especially if you use the techniques that we've gone through in this semester, in this class, to show you about prudent long-term investments. You don't have to take big risks. You don't have to win big. You just want to win. But notice that overall, between 1989 and 2013, emerging stocks were the winners in the most years. But there's a reason why they're also sometimes called submerging markets, submerging stocks, because notice the volatility is real. Sure, they did 30, 40, 39%, 55%, and then down half. And that half is a lot harder going down than it is going up. Notice in the late 90s where the US large company stocks just really creamed everybody else. Now we really need to update this table. And for those of you who are good at data gathering, data statistics, anybody want to volunteer? I'm just not very good at it. And so I need some help. So if anybody wants to help, see if they can find let's round out this table up to more current years. But still, it shows that diversification has been one of the best methods to reduce risk. Because if you had a smattering, maybe a little bit of small company stocks, maybe some international. I like global funds myself. Global, the United States certainly is some place that you don't want to ignore. And then you want a little bit of spice, a little bit of emerging markets, because that's where the growth of the demographics is. And then for those people who need some bonds, bond exposure, yes. Diversification has been one of the best methods to reduce risk. But how do we measure risk? We've come full circle. Way back in chapter 1, we introduced the tug of war between risk and return. We saw how higher the average annual return, the higher the standard deviation and its companion measure variance from the average annual return. We don't know what's going to happen next year. We just know that some asset classes are going to be more volatile than others and going to often deviate from the average annual return. We've studied the major financial asset classes: mutual funds, stocks, bonds, cash. We discussed the risks and returns of each. We found that return is easy to measure, folks. How much money did you make? How long did it take you to make that? That's your return. But risk is very difficult to measure. It's even harder to anticipate. Witness 2008. I was absolutely sure, my buddy, we said, market's going to take a dump. It's inevitable. But we didn't think he thought it was going to go down a whole lot more than I. I thought, 20%, 25%, 56%. Oh. So, we've come full circle. Variance and standard deviation, its more useful companion, tell us how much an asset class will vary from the expected return that we should get unless the world ends over the long term. The measures are readily available from the investment community, and the numbers aren't pretty, dear students. For any randomly selected stock on the New York Stock Exchange, the standard deviation is almost 50%. That means in any one year, many stocks on the New York Stock Exchange, which are some of the most stable stocks, right, and the NASDAQ now, will vary up and down close to 50% from their average annual return. Recently, Apple's standard deviation was over 38%. And this is the world's most, the company with the greatest market capitalization in the world. So how can we reduce the variance? In other words, how do we reduce the risk? The answer, of course, is to diversify. If we go from one randomly selected stock to two randomly selected stocks, the standard deviation goes down from 49% down to 37%, just by adding a second randomly selected company. Obviously, if we selected companies that were more volatile or less volatile, the numbers would be different. But we're talking about just randomly picking two different companies. If we randomly pick 10 companies, the standard deviation goes down to 24%. 20 companies, it goes down to 21.5%, and so on. Diversifying our stock portfolio reduces our risk substantially, as measured by reduced variance and standard deviation. So this is a graph, it's a table from a very famous paper back in 1987. As we add the stocks to our portfolio, we see the expected standard deviation falling, and this is a percentage of the standard deviation compared to a single stock. So obviously if it's one stock, 49%, that's 100%. But if we just go to two randomly stocks, it drops to 76% of 49%, and that's 37%. And so on and so forth. But what do we see? Once we get up to 75, 100, 200, 300, 500, wait a minute, what's going on? What's going on? We keep adding more stocks, but the standard deviation barely budges lower. Here is a graph of that. And you math fans will know what this is called. It's called a limit. It's a limit graph. There is a limit to which diversification can reduce your risk in any given asset class, in this case, stocks. As we increase the number of stocks, the standard deviation falls until it hits a limit of approximately 19%, after which it will fall no further no matter how many stocks we add to our portfolio. Why is this? Why is this? The answer is correlation. It's a fancy word, but let's take a look at what it means. Slide number 9. It's the tendency of the returns of two assets to move together. Imperfect correlation is the key reason why diversification reduces portfolio risk as measured by the portfolio standard deviation. Sound like a test question? Imperfect correlation is the reason why diversification works, because no two investment returns will be exactly the same. Positively correlated assets tend to move up and down together. Negatively correlated assets tend to move in opposite directions. So here is the correlation coefficient. And for some reason, students don't want to learn this. I don't know why, but I want you to learn it because it's important. Especially when people ask you questions like, well, I have a lot of stocks. How come I still have this volatility? You're not going to get away from it. Why? Because of the correlation, and the correlation coefficient is how we measure correlation. It's the measure of how closely returns on assets move together. And the mathematicians use -1 or -100%. You can think of it as a percentage. A -1 as perfect negative correlation. The two go in opposite directions. Up to 0 where there's no correlation. They go on their own. One goes one way, the other goes the other way, and then they just don't follow one another either negatively or positively. And up to 100%, perfect positive correlation means they both go in the same direction. They use the variable R. That makes a whole lot of sense, right? Correlation coefficient. I don't know. I remember my undergraduate degree is mathematics, and I never understood why we have to use single letters for variables. It just doesn't make any sense. I'd much rather use the word correlation. Wouldn't that make more sense? They don't like me. They think I'm silly, but I think it makes more sense. And of course, in academia, our motto is, if it makes sense, we don't do it. Slide number 11. Here, Slide number 11. Here is a graph made by Ferran Capo of Studio Capo in Spain. Thank you very much, Ferran. We really appreciate it. And it shows 3 scenarios. These two assets are perfectly correlated. The correlation coefficient is 100%. One goes up, the other one goes up. The other one goes down, the other one goes down. And not necessarily as great as the other one. One's more volatile in that it goes up higher and goes down lower, but they move together. On the other side of the coin is perfect negative correlation, -100%. One goes up, the other goes down. The other one comes back up, the other one goes down. Now, it's very rare that you'll get -100%, -1, or 100%, +1. But you see maybe 70%, 80% in negative or positive. And then here is an example of what happens when the two are just random, right? There's no correlation. They're uncorrelated to one another. The correlation coefficient is 0 or 0%, however you want to think about it. So think about it, folks. This is why diversification cannot get rid of all the risk. Because how does this answer Does this answer our question about why diversification can only reduce by so much the risk of owning stocks? Although stocks are not perfectly correlated, remember, imperfect correlation is the reason that diversification works. Stocks are positively correlated enough so that stocks in general tend to move in the same direction. And this is intuitive. That's why we often refer to stock investments as a whole as the stock market, because they tend to follow one another, even though at any given time, some companies are doing well, others are doing poorly, and many are simply chugging along as they always have done. So you see, keep adding more stocks, they're positively correlated to one another such that you can't get rid of all the risk. Oh well, darn. Slide 13. That's still too much risk for me. I think I's going to stick to bonds. You are a very conservative, risk-averse investor, and you don't like the volatility of stocks. Therefore, you decide to place all your investments into bonds. For the long term, you will accept the lower return from bonds in exchange for the lower risk of the bonds. Oops, bad idea. Why is that? Well, because like stocks, bonds are positively correlated with themselves. They will also tend to do well or do poorly as a whole. More along interest rates, right? They follow interest rates. And they also are often negatively correlated with stocks. What does that mean? That means when stocks are doing well, the economy's going well, earnings are growing, people are getting raises or new jobs, and everyone's happy. What happens to interest rates? They start going up. Bond prices go down. Stocks, on the other hand, are doing great. A recession hits, what happens to stocks? Stocks get hammered, earnings get hammered, people lose their jobs. But what happens to interest rates? They go down, bond prices go up. Stocks and bonds often, but not always, move in opposite directions. You see? You see? Here is a graph. Now, I got this from Capital Group, and this is a long time ago. We really need to find new data because I'm not too sure that this is as perfect a graph as it seems. But here, if you start with 100% stocks and 0% bonds, you're going to have the highest return over time, approximately 12%, maybe actually less, 10 to 11, but let's say 12%. And you're going to have the highest volatility, let's say 15%, maybe 18%, depending what type of stocks you have. As you start adding bonds, the return starts to drop. Well, that makes sense. Bonds return less than stocks over time. And so does the standard deviation. So does the risk. The volatility drops until finally you hit this inflection point. Here, with 30% stocks, 70% bonds, you have a return of less than 8%. And you have a standard deviation, 8.5%, 8.6%. But now as you reduce the number of stocks and add the number of bonds, the standard deviation starts to go back up. At the same time, the return starts to fall. What a bad deal that is. I'm getting a lower return and the standard deviation, the risk, is going up. And this is the graph that is quite old, so we need the table. So we really need to do our best to update this. So if any volunteers, because remember, this is an open educational resources text and everyone is freely available to watch our videos and the like. I'm committed. I know I should be committed, committed to keeping it free for everyone. So if anybody can help me, please think about it. So see what happens? This is the table that we just saw in the graph. As we reduce our stock exposure, our standard deviation goes down. That's what we expect. And our return goes down. That's what we expect. Until we hit this inflection point right here at 30% stocks, 70% bonds. Now, as we reduce the number of stocks, add to our bonds, we start seeing the standard deviation creeping back up. At the same time, our expected return goes down. If we're long-term investors, a combination of stocks and bonds actually created a portfolio with less risk while earning you more than just bonds. If you are seeking less risk, it not only pays to diversify within an asset class, buy more than just one stock or more than one just bond, it also pays to diversify among asset classes. This same kind of relationship occurs or has in the past with foreign stocks and foreign bonds, but now less than you did in the past. Of course, some people will say, well, you should have some real estate too. Well, that's not a bad idea, and we'll talk about real estate later on. But typically, people are going to have a goal of buying their own home. So in that respect, they're going to have some real estate, even though it's not really an investment; it's a house that they're going to live in. Although diversification, dear students, doesn't matter how diversified you are, it's not a guarantee of positive results. No diversification scheme worked in 2008, unless your idea of diversification was short-term investments and treasury bonds. Those were the only things that everybody fall down. Real estate, stocks, bonds, Commodities, hard assets, gold, everybody fell down. Oil, we have a name for choosing the appropriate mix for an investor. It is called, come on, go to the next slide. It is called asset allocation. It's actually just a fancy term for how much should I have in stocks, how much should I have in bonds, how much of each stock and bond. For many decades, investors were advised by their advisors to have a formula that was subtract your age from 100. But now they're using 110, 120. Why is that? Hang on a minute. That's the percentage of stocks you should own. The rest should be in bonds. So say you're a 40-year-old person, you should have 100 minus 40, or 60% in stocks and 40% in bonds. Now, there are others, myself included, who say poppycock. It's just, buy high quality stocks, put up with the risk, don't panic when the market falls. In fact, that's the best time to buy, right? Unless the world ends, in which case it doesn't matter where you put your money in. Once you near retirement, in your 50s or so, start buying bonds because you need that ballast. But don't give up on stocks entirely. Even if you think at 60 years old with this formula, they still want you to have 40% stocks. And other people were telling their 60-year-olds, this was 50 years ago, you should have everything in bonds because you're not going to live that much longer. And it's true. That's why this number is going up to 110, 120, because people are living longer. And I wrote down the statistics in the book. I forget what they are, but I heard some strange ones. But if you made it to 65, I think you have another 20 some years if you're a woman, and maybe 21 if you're a man. Statistically, right? Some people have a lot longer, some people a lot less. So you still want to have that growth in your portfolio. Excuse me. So let's take a look at an example. So, hey, this is not what I would do. Certainly not what I would do if I were recommending somebody maybe in their 20s and 30s. But let's say they got an inheritance of $100,000 and they're very conservative. They want to not lose the money. You try to make them understand that, volatility is part of investing. And if you have a long-term focus, unless the world ends, they're going to do okay, I think. So let's put them in 25% bonds, 75% stocks. In that 25% bonds, maybe 15% of it, 15,000, would be in the high-grade corporates, government bonds, high-yield bonds. Maybe this is 5% of your portfolio, junk bonds, and then maybe some global bonds. Then the vast majority should be in stocks. 3/4 in this case, 75%. I love growth and income. That's my favorite. Domestic and global. Actually, I'm more partial to global. And then here's our spice. A little bit of aggressive growth, 10%. A little bit of outside the United States, international. And then how about 5% in small company stocks? You like that allocation? When you have $100,000 lying around the house, please feel free to use it. Whether through mutual funds or buying individual securities. Rebalancing. Another very popular diversification strategy is the technique of rebalancing. Every year, you check to see if your percentages are still in balance. If stocks have had a banner year, well, what's happened? Bonds probably didn't do much, right? They didn't go up very much. Maybe they went down a little bit if it's a really strong economy and interest rates went up. You might now be 70% stocks, 30% bonds, instead of your target 60% stocks, 40% bonds. So what would you do? You would sell enough stocks and buy enough bonds to bring the balance back to your target 60-40 allocation. Likewise, if stocks have tanked, now maybe you're below your 60% stocks and have 50% bonds or 60% bonds. You would sell bonds and buy stocks to bring the percentage back up to 60-40. Now, why is this a good idea, in my humble opinion? Well, it forces you to do the right thing. It forces you to buy low, sell high. Stocks are doing well. Who wants to sell? Hey, look at it. It's doing great. No, it's time to take some, you'll hear people say, it's time to take some money off the table. And the same thing is true if stocks have tanked. it's time to go out and buy some. I don't want to buy stocks. They're falling. Relax, relax. And this is what, in my humble opinion, the good balance funds do. Remember we talked about the one balance fund that never gets more than 75% stocks, 25% bonds, and down to 50% stocks, 50% bonds. So if they were to fall, if they were to go above 75% stocks because the stock market had done really well, they would have to sell some of those stocks. And if they went below 50% stocks, they would have to sell some of their bonds to bring the balance back up. So it forces you to do the right thing. Now, is it a guarantee? No, of course not. It's just a strategy that helps smooth out the highs and lows, the ups and downs of the marketplace. Cool? Yeah, I think so. Now, next slide. Many advisors suggest that retirees shed the bulk of their stock investments in favor of bonds and cash investments. Well, we've already mentioned the problem with this is that people living much longer, right? A 65-year-old couple, there's one statistic that I found, has a 45% chance that one of them will survive to age 90. So that's, 25 years or so. As you near retirement, start migrating your investments from stocks to bonds, but don't abandon stocks entirely. Now, on the website and in Canvas, we have some illustrations where we showed you a bond portfolio only, using bond funds, right? And then in retirement, a stock-only portfolio, and then a balanced portfolio. And I, especially when people get to be in their retirement age, I'm a big fan of balanced funds, personally, and everyone's different, right? Well-run balanced funds, not the tactical ones that put everything into stocks and everything in the bonds, everything in the cash. No. You want a balanced fund that stays balanced. And what you'll see is that, as we've intimated throughout the journey, we want to be able to eat reasonably well and sleep reasonably well. And balanced funds, I believe, are one great strategy for doing that. Prudent, long-term investors, even in retirement, still need some growth. As you'll see we really want you to, and of course in the face-to-face class we would stop and now show that, but you make sure you go check that out. It's on the website, it's in Canvas. Make sure you check those illustrations out. Cool. So now, slide 21. Here's yet another example of why having a balanced portfolio is a cool thing. Here are, from 1987 to 2013, large company stocks, U.S. bonds, and a balance of stocks and bonds. And notice that only once did the balance combination have a higher return than either all stocks or all bonds. But at the same time, if you run through these numbers, you'll see that the balanced one smoothed out. Here, this is not bad. Look, 16.6 stocks did in 1988, 7.9 bonds did, the combination did 13. Would you be happy with that? 1989, 31%, 14%, we did 24%. And here, when stocks fell in 1990, bonds went up, we still eked out a return, even though our stocks had gone down. So the having the balanced fund means that you almost never have the best returns in any one year. However, it also means you will very rarely ever have the worst returns in any one year either. In addition, although it is very unlikely that you will not equal or surpass an all-stock portfolio, you should do better than an all-bond portfolio. But you know what we're going to have. There are no guarantees. Now, we come back to this old idea that we had, and that's dollar cost averaging. Most of us are living our lives, doing our work, watching our kids grow up too fast, making the bill payments, and we just don't have the time. Now, some of you are going to get involved in this. You're going to get excited about this. Maybe this is going to be your career. You're going to join an investment club. Who knows? And it will be a hobby for you. But most people are just not like that. And even if you are, it still makes sense to dollar cost average. Out of your paycheck, your 401k, 403b into a Roth IRA out of your checking account. Dollar cost averaging, if you remember way back in chapter 2, is a system of buying an investment at regular intervals with a fixed dollar amount. With dollar cost averaging, there is always good news. And this is what I had to convince my wife many years ago when we met. She was terrified of stocks. And I said, look, Anita, because that's her name, Anita. No matter what happens, tomorrow morning when we wake up, the news is good. The market's up. Good news. Yippee. Your account is worth more. Your $100 is now worth $100.20, right? The market's down. Good news. Huh? What? No. Next month, you're going to get more shares at a lower price when the $50 or $100 comes out of your paycheck or checking account. Now, look, I have racked my brain trying to come up with a better name than dollar cost averaging. Some people use systematic investment plan, automatic investment plan. I don't know. But it's about the easiest and most accessible and convenient way for most of us working grunts to invest. Have the money come out of our paycheck, automatically come out of our checking account and into the 401k, into the Roth IRA, assuming, we're doing it with mutual funds. If you want to buy individual stocks, well, then you have to put the money into your brokerage account in the, the money market, in the cash part of your brokerage account. Wait for it to get up a little bit to 500, 600, and then buy 10 shares or 5 shares or whatever. But now brokerage companies are allowing you to buy, 0.3 shares of a company. And you say it's Amazon or Google with, $2,000, $3,000 stock. They let you buy $300 worth of it. But as I said in the past when we were talking about this, I still don't know what kind of price you're getting. I don't think you're getting the best price when you do this because it costs them money to manage this. So I'm sure they're going to give you a lower price than what if you had bought a single share of it. But still, dollar cost averaging is cool. For the vast majority of us, it's the only way many of us are ever going to invest. Is it a guarantee? No, 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 no. Let's take a look at this example. In this example, it's 2007, and we bought $1,000 at a share price of $10, and we got 100 shares. So now we have 100 cumulative shares. Next year, 2008, the stock market falls 50%. So the price is now $5. So we put $1,000 in. It could be years or months, whatever. And it doesn't usually lose 50% in 1 month, but it could. It probably will someday. It goes down to $5. So now we buy $1,000 worth, we get 200 shares. The third year, it comes back with a vengeance, and now the price is $7.50. So we buy $1,000 worth, dollar cost average, and we have 133.3333 shares, and we have 433.33 cumulative shares. In this example, your average cost per share is $6.92. The $3,000 that we invested divided by the 433.333 shares. But the price per share is $7.50 currently. So although it looks like we simply have broken even, we actually made money because we bought more shares at the lower price, fewer shares at the higher price. The value of our shares is $3,250, the 433.333 times 750. So it looks like magic, right? No, it's the fact that the dollar cost averaging is tilted toward buying low and not buying as, when the prices are low, we buy more shares. When the prices are higher, we buy fewer shares. Now, by always investing the same amount of money, you are purchasing more shares when the price is low, fewer shares when the price is high. Your average cost per share should be lower than your average price per share. Now, I asked you to remember that back in chapter 2. I'm going to ask you to memorize it now because this is how you're going to explain it to people, and they're not going to understand you, but you're going to show them these examples, and they're going to come away and finally go, yeah, I guess it's a good idea to put $50 a month away. I mean, I spend $130 on my cell phone. However, it is not a guarantee of success. Dollar cost averaging is not going to help a lousy investment turn a handsome profit. Oh yeah, the price keeps falling down. Look how many shares I have. Oh, the company's gone bankrupt. I guess I don't have any money left. But it does make investing very, very easy, convenient, brain dead. You don't have to worry about it. It's going to come out of my paycheck anyway. For mutual fund investors, that is, right? It's a little bit trickier with stocks and bonds, but it's not impossible. As we said, you let the money accumulate in your cash portion of your brokerage firm, and then when you have enough to buy some shares, you then purchase your shares. But it's just so easy with mutual funds. Speaking of mutual funds, wasn't diversification one of the two main reasons why so many investors choose mutual funds? Yes. What's the other one? It should be burned into the back of your eyelids. Professional money management. But does that mean that mutual funds necessarily have less risk than individual portfolios or the market as a whole? Well, it all depends on which mutual funds we're talking about. So here's just 3 in the assignment. I give you many more. Check ones in your 401k, your Roth IRA. Check ones that you did back in Chapter 2. And take a look at those risk factors. Now, we're going to revisit standard deviation, but I also ask you to look at the beta and the alpha and the Sharpe's ratio and the, what's it called? The trainer rate. I forget. I don't use it. Because some mutual funds are very good at lowering risk. Now, typically, they're not going to have the highest returns. Okay. I'll accept the lower return for the lower volatility. Other people will say, nah, what's the saying now? Scared money don't make money. Oh boy, is that a recipe for disaster. And what I really want to do, I haven't done it, but I'm thinking about how to put it, it's ruminating in the back of my head, is to create a bonus assignment and see if people can go look at balance funds. Because typically balance funds should exhibit less volatility than both stock-only funds and bond-only funds. But I don't think they do. And that's, of course, time is the major constraint. I've been meaning to do my own research, but I got to get these presentations out the door. I'm almost, excuse me, I'm almost finished the book. It's not quite finished yet. There's still some things that have to be done. If you looked at the presentation in Chapter 10, you saw that one graph. I'm working with somebody to get that graph done. So it's almost done. In a few weeks, it will be all done, and I will submit it, and then it will be thrown out to the world at large. A free textbook, folks, there. Tell your friends and family. So that was mutual funds. Mutual funds should give us less risk as exhibited by standard deviation, but not all do. Some are going to be higher depending on their risk tolerance and their shooting for the moon, so to speak. So here is an example of what happens when the markets do really, really well and what happens when the markets do poorly. Mutual funds, we talked about diversification. Well, now we look at mutual funds and concentration. This is not the mutual funds' fault. It's not the fault of the mutual funds. This is the fault of the mutual fund investors. Remember back in Chapter 2, we said most mutual fund investors do worse than the mutual funds they invest in. And why is that? Well, look, what happens? The markets had done really, really well. They had gone in two directions, up and way up in the late 1990s, actually through 1982 to 2000. And 2000 was the peak, March of 2000. And we saw the inflows. That's these green or bluish bars. We saw the inflows just explode into mutual funds. Then the market started falling 2000, 2001, 2002. And it wasn't until 2003 that people started pulling out all their money out of mutual funds at the worst possible time. The market roars back in 2003. People put their money back in. The market collapses in 2008 and 9. What do people do? They pull their money out. And they didn't start putting money back in until 2013. Right. Many market historians have observed the tendency of mutual fund inflows and outflows to be a fairly reliable contrarian indicator of market performance. And if there's one thing I hope you've gotten out of all of what we've learned, is that panicking during a market downturn is going to kill you, folks. It's going to ruin your long-term performance. That's the time when we should be stepping up to the plate. The time of maximum pessimism is the best time to buy. Be fearful when others are greedy. Here. Be greedy when others are fearful, as Mr. Warren Buffett says. And dear students, we are done. This is it. We are finished with our journey on investments, stocks, bonds, mutual funds, short-term investments, asset allocation. No, not really. We're not quite done. Okay, we have some odds and ends to look at. Some things that hopefully you will learn to stay away from and to keep your friends and family far away from, speculations. We'll spend a little bit of time on real estate. That's a whole world unto itself. And then finish up with the discussion of brokerage accounts and talk about the ultimate investment, starting your own business. But for the vast majority of us working individuals who are feeding the children and teaching the children and giving injections to the children and to the adults and delivering the mail and all the other things that we do to earn a living, we've gone through the major investment alternatives. So you should be so proud of yourself. I am certainly proud of you. All of us at Southwestern are incredibly grateful, honored, privileged that you're with us, because now we're going to learn about some things that we really should stay far away from, unless we like to go to Vegas and pull on the slot machines, because we're going to find that these things are basically gambling. And if you want to gamble, it's your money, but just realize that the chances are that you're going to lose. Yes, indeed. So we are finished, but not really. You are Introduction to Investment students, so you need to learn about options, futures, and other speculative investments, a little bit on real estate and brokerage accounts, and then starting your business. And that will take us to the end of our journey together, dear students. We are so proud of you. Thank you so much for being in our class. Think about how much you have learned.